Obviously, then everyone has different goals when it comes to investing. And some where they tend to prioritize higher yielding stocks so that they can benefit from more income today, while others, they opt for lower yields that offer a higher level of dividend growth. The stocks that are the best for your portfolio, well, that basically comes down to your individual investing strategy. However, in today's video, I'll be talking about 5 different stocks that I really do think have a place in any portfolio, and they basically have the best of both worlds. They both have a high dividend yield and a high dividend growth. So no matter what your goals are, then these 5 stocks here, they should bring you closer to reaching them. But in case you're new to the channel, then my name is Casper, and here we strictly talk about investing and financial freedom. So if you really like investing and are on a mission to retire early, well then press that subscribe button below. But without wasting any more time, then let's get straight into the first stock on my list. So the first one on my list today is one that a lot of investors are talking about, and that is Target. But seeing as the dividend yield on this Dividend King here is now above 4%, which is almost 80% above the company's 5-year average, well then I definitely do think that it does deserve a spot on the list today. And when we look at the rest of the dividend stats, well then we do really see why a lot of people are talking about Target recently. They have a dividend yield of 4.10%, and that is absolutely amazing. However, they also have a 5-year growth rate of almost 12%, and that means that the dividends have on average grown by 12% per year for the last 5 years, and that is really insane. And on top of that, then they have also consistently been increasing that dividend for the last 54 years in a row. But not only is Target looking really great based on their dividends, but based on their price, they are also looking really attractive right now. Target is down by almost 30% year to date, and that is a pretty big drop. And when looking at the last month, well then we do see that they're down by 3.2%. And right now their share price is really low, and that puts them very close to their 52-week low. So overall, then is both the dividend stats and the price looking very attractive for us investors. So if you have been looking into buying Target, well then right now might not be the worst time to buy this Dividend King. So moving on to the second stock on my list, and here we have Lowe's, who's really come down a lot in a short amount of time, and retail in general has been hitting hard lately. And some of that was due to a big jump in retail theft that has basically led to massive losses for the companies. However, they are down by 6.5% year to date, and when looking at their performance just in the last month, we do see that they are down by almost 12%. They currently have a PE ratio of almost 14, and that is actually not that bad. However, it is almost 21% below their 5-year average. So there is a bit of a discount to be found here. Not only is the current price looking pretty good, but the dividends for this company is looking absolutely amazing. Based on the dividend stats here, well then we do see that they have a dividend yield of 2.3. They also have a payout ratio sitting at 31, and that is absolutely amazing because it means that this company can very easily sustain the current dividend, and they can also increase it even more in the future. However, they do have a 5-year growth rate of almost 20%, and that is absolutely insane, and that does make this company a high growth dividend stock. And they have also managed to increase this dividend for the last 60 years in a row. Overall, then there is a bit of a discount to be found here for this Dividend King. However, the real selling point is definitely the dividends. They have been increasing that dividend extremely fast, and they have been very consistent with it. So moving on to the third stock on my list today, and this is also one that I have been talking a lot about recently, and one that I just keep on buying, and that is of course Realty Income Corp. They are down by 22% year to date, and during the last month they are down by 3. And they are right now sitting really close to the 52-week low. Overall, then is this REIT here taking a very huge hit in 2023, and the price right now is so low that I just simply can't stop buying it. But let's have a look at the dividends, because that is simply the best part of this REIT here. They have a dividend yield of 6.19%, and that is extremely high. They also have a payout ratio sitting at 74%, and even though I would usually say that a payout ratio of 74% is a bit in the high end, then for a REIT that is completely normal. They also have a 5-year growth rate of 3.7%, and even though that is not completely amazing, then it is pretty good when considering that they already have a very high dividend yield. They have also consistently been increasing that dividend for the last 25 years in a row. And as I mentioned before, then I do own this stock here, and it is actually one of my largest positions in individual stocks, and it will most likely continue being so because the dividends that you get from having this stock is absolutely amazing. But moving on to the fourth stock on my list, and here we have Chevron. Ever since the global pandemic, the oil stocks have been increasing a lot, and this sector has been one of the best performing stocks since. And Chevron has been a big winner for very many investors. A couple of days ago, they bought a very big oil company called Hess for $53 billion, and that does make their position in the market even stronger. Year to date, then they are down by 10%, and during the last month, their stock has decreased by 6%. So right now their share price is looking really solid, especially when considering that they just bought this company, which does make them even more interesting. They currently have a dividend yield of 3.68%, and that is actually pretty good. They also have a payout ratio sitting at 36%, and again, well, then it means that they can very easily sustain the current dividend, and they also have room for improving the dividend in the future. So that is amazing as well. They have a 5-year growth rate of 6%, and that is also pretty good. They are slowly but consistently increasing their dividends, and that is absolutely amazing when you're a dividend investor. They have also consistently been increasing this dividend for the last 35 years in a row. Overall, then is the current price for Chevron looking pretty good, and when considering that the demand for oil right now is pretty high, well, then it is not unlikely that this sector will see an increase in the future. And when looking at the dividends, well, then we do also see that they have been very consistent with their dividends, and they are increasing at a pretty good pace. So moving on to the fifth company on my list, and here we have one of the companies with the highest brand loyalty in the world. It is something that a lot of people are buying on a daily basis, and that is of course Starbucks. They have more than 37,000 stores globally and branded coffee in hundreds of thousands more stores. There is basically no one out there that sells or buys more coffee than Starbucks does. And year to date, well, then they are down by 6%. However, during the last month, they are actually up by 1%. They are trading at a price to earnings ratio of 27. And even though that is normally pretty high, then it is still 24% below their 5-year average. So there is a bit of a discount to be found here as well, which we don't see very often for Starbucks. But let's have a look at their dividend stats. They have a dividend yield of 2.41% and a payout ratio sitting just above 60%. And that is actually a pretty high payout ratio. However, it is also a company with a very strong cash flow. And it is not a fully matured company, but a company that is still growing at a pretty fast pace. So I wouldn't be too concerned about that. They also have a double-digit 5-year growth rate of 11%. So they are also increasing their dividends at a really fast pace. And they have consistently been increasing that dividend for the last 12 years in a row. Overall, then is Starbucks looking really interesting for us investors. It is usually trading at some very high multiples, but it seems like they have fallen a bit, and they are right now at a point where they are starting to look really attractive, both based on their price, but also based on their dividends. That was basically all I had in today's video. Please let me know in the comment section below if there are any cheap dividend stocks that you are looking to buy at the moment. Thank you for watching the video. I hope that you enjoyed the video, and if you did, then don't forget to smash the like button below and subscribe to my channel if you want to see more weekly content just like this. See you guys in the next one.